Hi there, it's Grant here, and welcome back to the Fast Track Options Trading Challenge. We're into video 3 now, and in this video, I'm going to take a closer look at call options. I'm going to give you some examples, so basically you can see why you would buy a call option, why you would sell a call option, and the ways you can make money when taking out or buying a call option and selling a call option. In the previous video, I showed you the 2 different types of options you can have, and also the 4 different trades you can make with call and put options. But with this one, we're going to be taking a closer look at call options. So with that said, let's get on with the video. So let's just sort of recap what a call option is. So a call option gives the options buyer the right but not the obligation to buy a stock at a specific price by a specific date. So let's look, if you remember, this is the option example I showed you in the previous video. We got Simon, who's going to be the call option buyer, and we're going to have Chloe, who's the call option seller. And they're basically both betting on stock X. So Simon's betting that stock X is going to go up, and Chloe's betting that stock X is going to fall. So in exchange for $15, Simon has the right to buy stock X for $100 per share at any time before December 30th. In order to have this right, he pays a $15 premium to Chloe for taking out the call option, but that gives him the right to buy stock X from Chloe at $100 per share. Now, basically, Chloe, the option seller, she collects a $15 premium from Simon, but in order for collecting that $15 premium up front, she has the obligation to sell stock X Simon for $100 per share. Now, let's look at this trade from Simon's point of view. Simon is basically betting that stock X is going to rise above $100 per share by at or before December 30th. If it does, basically Simon will exercise that option and force Chloe to sell stock X to Simon for $100 per share. So $100 is the strike price. Simon wants the price of stock X to rise above the strike price. So basically Simon can make money. At any time stock X rises above $100 per share, which is the strike price, Simon will execute that option and basically force Chloe to sell stock X to Simon at $100 per share, in which case Simon makes a profit, because at the end of the day, if he's forcing Chloe, to sell to him $100 per share, and say if it goes up to $150, well, basically Simon is in the money. He's going to be making, his profit is going to be $150 minus 150 minus the premium. So Simon makes $35 if it went up to $150. So anything here, Simon makes profit. Now, if stock X were to fall below the strike price at any time before December 30th and it doesn't go above the strike price, Simon loses money. He'll just let the option expire worthless, and then basically his loss will just be the $15 premium paid. So thing to remember here, Simon is taking out this call option because he thinks stock X is going to rise above the strike price, $100 per share, at or before December 30th. Anything up here, he's in profit. Anything down here, he loses money. So hopefully that's clear to you. So let's look at this trade from Chloe's point of view. So Chloe is betting that basically stock X will not rise above $100 per share, which is the strike price, at any time before December 30th. So if obviously the stock price of stock X rises above the strike price of $100 per share at or before December 30th, Simon will execute or exercise the option, forcing Chloe to sell Simon stock X at $100 per share, in which case she is going to lose money. Obviously, if stock X doesn't rise above $100 per share here, basically, and Simon just lets the option expire worthless, Chloe makes money and she will walk away with a nice $15 premium that she collected in her pocket. So the important thing to remember here, Chloe is selling this call option because she doesn't believe StockX is going to rise above $100 per share at any point between December 1st and December 30th, in which case she makes money with the premium she collected, but she'll lose money if it does rise above the strike price $100 per share, because the option will be excised and she'll be forced to sell the StockX for $100 per share. So I really hope that is clear to you of why you'd buy a call option and why you'd sell a call option. So well done for watching the video and getting to this point. If you're following along, I really appreciate you following, and I really hope that the concept of options trading is starting to sink in and you're beginning to understand what options trading is and how you can start to make money with options trading. So in video number 4, I'm going to be looking at put options with examples. So that's what we're going to be looking at next. So if you enjoyed this video, why not like it? And if you haven't subscribed, subscribe to the channel so you can get notified when more of these videos get released and more content that we release to the channel. Last thing I'll say, I'm going to leave my favorite options trading resources and financial advisories below. The links below are going to be to One Ticker Trader, Jeff Clark Trader. These are 2 expert trading services that give you, options trades that you can execute, so you can maximize your profit. Because the big problem when you start option trading, you don't know what stocks to buy or sell with options. So these services take a lot of a risk out because they're professionals. They do this day in, day out, and they give you the best picks that will allow you to, the best chance possible to make profitable options trades. If you want to check them out, click the links below. They're only $19 each, so why not check them out and if and see if they're right for you. Anyway, I really appreciate you watching this series, and I hope it's helping you, and I look forward to seeing you in the next video.